Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of corporate filings. This time we are decoding FS Bancorp's latest 10K. You know, the usual holiday reading material that keeps everyone up at night, just kidding. This report gives us a deep dive into the company's performance over the past year and a peek into what they are worried about. Basically, they're a community bank focused on serving families and businesses in the Puget Sound region and some parts of Oregon. The big picture? Total assets are up a bit, reaching $3.03 billion. That growth is thanks to more loans, but let's dig into the numbers to see what's really going on. One thing that stands out is commercial real estate or CRE loans. They make up a significant chunk of their lending, but it's a riskier area than plain vanilla home loans. As of the end of the year, they had $590.5 million in these loans. That's about 23% of their loan portfolio. A lot hinges on how well those properties perform. Let's talk about the allowance for credit losses. This is the money the bank sets aside to cover potential loan defaults. At the end of 2024, that stood at $31.9 million, representing 1.26% of their gross loans. They're trying to stay ahead of the curve. Now here is where things get a little spicy. Net charge-offs, loans they had to write off as uncollectible, are up. Looking at net charge-offs in the consumer portfolio, we can see indirect home improvement at 0.67% versus 0.36%. This means losses from those indirect home improvement loans more than doubled. Overall, their total net charge-offs divided by average loans outstanding is up to 0.21% from 0.9%. These numbers tell us about potential trouble with some of their loan customers. On the other side of the balance sheet, total deposits actually decreased. They're down by about $130 million. People are pulling their money out and placing it elsewhere. While total deposits decreased, a concerning point is that less than satisfactory loans within any given pool, as opposed to those last graded as satisfactory. It increased to 43.28%. They're still active in selling mortgages. During the year, they sold about $565 million in loans in the secondary market and earned $4.7 million in servicing fees. This part of their business is important for generating income and managing risk. Of course, every report has the risk factors section. They're worried about downturns in the economy, especially in their local markets, the Puget Sound region and other parts of Washington and Oregon. They also mention the usual suspects, including interest rate changes and competition. They also talk about disruptions to their tech systems, cybersecurity breaches, vendor failures, and even the effects of climate change, all things that could hurt their bottom line. Joe Adams is the CEO. Matthew Mullet was recently promoted to president, which is definitely something to keep an eye on to see how the power dynamic evolves. A couple of other executives also got promotions. The report highlights Shanna Allen, the Chief Information Officer, who has over 25 years of technology and banking leadership experience. It highlights they plan to make an effort to make sure they are well prepared with the ever-changing technology landscape. Jumping over to human capital, they're pretty proud of their volunteer efforts, totaling around 6,000 hours. That is amazing for a company of that size. The bank is considered well capitalized by regulators. That's a good thing, meaning they've got a solid financial foundation. Their capital ratios all exceed the minimum requirements. They mentioned they are subject to a broad array of federal and state consumer protection laws. Non-compliance with federal or similar state privacy and cybersecurity laws and regulations could lead to substantial regulatory imposed fines and penalties, damages from private causes of action and/or reputational harm. Executive promotions, financial ups and downs, all that jazz aside for a second, let's get real. FS Bancorp, while seemingly stable, is in a really tough spot. Their key metrics, which are interest income, profit, and deposit accounts, are all in the red, all while having a concerning number of substandard loans and no actual real plan of how to turn things around. If I was an investor, I would be very worried to see the price tank. Thanks for watching Corporate Decoder. If you have any companies you want me to review next, let me know. Also, if you enjoyed this video, please subscribe, like, and comment.